This is the next big risk. I'm Sonali Basak. Across the world, risks are percolating from geopolitical strife to a stock market in the U.S. that's become increasingly concentrated in a handful of large technology giants. It's a job for an investor to navigate the next big risk. One corner of the financial world has expanded meaningfully in a bid to capture the investment opportunities of tomorrow, and that's private credit. We asked three giants of the nearly $2 trillion industry about what concerns them over the next 5 to 10 years. Purnima Puri, managing director at HPS Investment Partners, worries that changing demographics and dropping fertility rates will lead to a labor shortage that could stall U.S. growth. Jonathan Lewinsohn, co-founder and managing partner at Diameter Capital Partners, sees the deluge of misinformation and political identity threatening the objectivity of investors. And Josh Easterly, co-founder and co-CIO of Sixth Street Partners, wants to see a better education on the style of risk management required to succeed in private credit. But we begin with Purnima Puri. We discuss her concerns about the link of demographic changes to slowing U.S. growth. Over the 5-10-year horizon, what are the next big risks?
The big risk is growth, and within growth, potentially a labor shortage. And maybe that's an underappreciated risk that's floating out there. Aging population coupled with declining fertility rates makes for a shrinking workforce. And a shrinking workforce then makes for potentially lower growth or more reliance on productivity. So aging population, declining fertility are two really big components to organic population growth. So that keeps me up at night, because growth is population growth plus productivity, and population growth is organic growth plus immigration or migration plus productivity. So, depending on where we land on immigration, that could be an underappreciated risk in the market in terms of its contribution to how the economy's grown.
Do you worry about productivity and the ability for the U.S. to be productive enough to really fill the gap you're talking about?
I think you have a spend problem, which is that the aging population puts more pressure on what's needed to support that population over the long period of time that we're looking at. And so I worry about that. We've been tracking at high productivity, I guess, since the end of 23, and the numbers are close to 2%. And that's more than most other countries, by the way, also, right? But if you look at numbers over time, and McKinsey just came out with this report, they said, between 2012 and 2023, productivity in the U.S. is just sub 1%. And we need to get to just sub 2% in order to maintain where we are in terms of GDP. I think the underappreciated risk issue is that you're putting a lot of reliance on productivity, and it feels like we're in the right direction there, but it feels like there's lots of other variables that could upset the mix.
It seems like if you have an aging population and there's so much of the existing U.S. budget that goes towards supporting that, then how much of a problem is it that you don't have the fertility rates to support that growth rate?
Let's pretend that you get fertility from 1.66, I think is the number, to 2.1 today. It's going to take 20 years still. It takes a long time for that to be the only lever. So I go back to kind of just the math on it. And the simple math is population plus productivity equals growth, right? And so then if you double click to population, you say, okay, well, population is organic population plus migration. And so you do have a lever that could be helpful between now and then. And ultimately, the numbers I've seen, and these numbers are all over the place, but the numbers I've seen are that the aging issue is pulling roughly 500,000 people out of the workforce annually. So that's a drag of 15 to 20 basis points. So you're really counting on productivity to make up for increased expenditures plus a lower workforce. So then it gets into, so is the real risk labor shortage, and how do you plug the gap?
So people might be working a lot longer.
People are talking about a mosaic of solutions, but there's not one lever, right? Because fertility is not going to solve this because it takes 20 years. Cost cutting is not going to solve it because you're working within a band of what you can actually do. So you got to do all of it, right? You got to potentially, there's lots of countries that have put incentives in place for fertility and for birth. There's lots of countries that have put incentives in place for childhood education and retraining and reskilling. There's lots of countries that are trying to move the retirement age. Ultimately, by the way, people that are over 65 still consume a lot. And so the other problem is a lot of people made a lot of money in the markets and in rising asset prices, right? And they made a lot of money in that, and that actually helped a lot to support 65 and on when you're not receiving your paycheck. But there's been a lot of shifts in the way this whole thing works. And so when you look and you go back to the higher rate environment, do we increase 401k contributions in order to help incent people to save more, to have more when they're coming out on the other end? They need it for longer. But we need more alternatives for people to invest in order to support this longevity.
What about the diagnosis? If the diagnosis at the end is worries about growth rates, how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit. And that's not good for the economy. You have a lot of burden that's being put in another generation, and that's going to create a lot of social strife. And so growth is really critical. And I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity, and I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Do you think investors are undercounting the risk? You've mentioned a couple of times that there's a few things that people are not really baking in around this math.
I think there's been more and more people that are focused on the debt problem and the deficit problem. So I think that risk of growth is what factors into those two problems. So I'm not sure that people are discounting it. What I wonder is whether there's been such a sea change on migration and attitudes towards it. I mean, I read an article recently, like 55% of Americans want immigration to be curtailed dramatically. This was like compared to like 41% a year ago or something like that. So I just wonder whether there's as much focus on the population piece of it, because I think there's a lot of people that are assuming we're going to be productive enough.
Coming up, Jonathan Lewinsohn, co-founder of Diameter Capital Partners. This is Bloomberg. Welcome back to The Next Big Risk. Jonathan Lewinsohn of Diameter Capital Partners and I spoke about the landscape of misinformation and how it affects Wall Street. He's increasingly worried about the massive unmarked sectors in the market that would cause problems if traders lose their objectivity.
The world is teeming with misinformation. It's deepfakes, it's AI, it's hard to work through. At the same time as this is happening, political identity is paramount, which means that people's political affiliation matters to their self-perception more than ever. And that doesn't only mean what their values are for the future, it's about what they think just happened. It's a debate about facts. Wall Street is supposed to be an island of objectivity in all of this. If earnings are good, the stocks go up. If earnings are bad, the bonds go down. But Wall Street more and more is adopting unmarked assets. Private equity, venture capital, private ABF, private credit. Those things aren't marked. Mark to market is what creates the need for honesty. And to me, the next big risk is, in this sea of subjectivity, in this changed environment, will investors really know what they own? Or does everything become Silicon Valley Bank and Lehman Brothers?
How does that make the job of an investor more difficult?
So let's step back first and play an experiment. I was on a trip recently with my 13-year-old son, and we saw a bumper sticker that said, "Inflation is a hoax." And he turned to me and he said, "I get misinformation, but," he said, "why would someone say something that you can see, like prices going up, is a hoax? What are they accomplishing?" And I laughed. But in reality, on Wall Street, as investors, we often rely on surveys of what people are saying in order to have a sense of leading indicators. During the election, it was Republicans who thought inflation was a problem and Democrats didn't. Now, magically, in January of 2025, it's flipped. And Democrats think inflation is a problem and Republicans don't. But it goes even beyond this issue of inflation that was a big one in our last election. We, for a long time, rely on just surveys of consumers, on CEOs, to tell us how things are. It helps us invest. It helps us understand the macro. And they used to be very, very valuable. But about 10 years ago, it changed.
If you're looking at an American public with two different views of the world, then how does that factor into decision making?
Well, we all know that from 22 to 24, everyone was obsessed with a recession. And it made a lot of sense. We all learned in school that if there's high inflation, rates go up, and therefore you have a higher probability of the economy slowing or contracting. But over time, what we saw was that hard data was doing okay. The economy was performing well. The soft data, particularly CEO surveys, didn't catch up with it. In prior periods, when there was worry about recessions and they were disproven, or by hard data, the soft data caught up, and it didn't this time. And in fact, when I would meet with senior investment bankers, I always asked them the question, what are the CEOs saying? Because they should have better insight than any. And throughout 22 and 23 into 24, they all said the same thing. CEOs tell me that their companies are doing great, but they're expecting a recession. We know from a Harvard Business School study that most CEOs are Republicans. At that moment in time, more Republicans thought the economy was going badly than Democrats did. And so that was reflected in surveys that investors tend to rely on. And so this objectivity, subjectivity that wasn't an issue necessarily in the past is now really challenging the ability of investors to rely on those type of factors.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. Being able to understand how your portfolio is performing relative to what's going on is not necessary for every type of asset, but if private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Do you think that too many investors are making decisions based on politics too often, whether they know it or not, because the views that are coming out are inherently political?
What we're learning as we look at society is that it's become impossible for us to divorce our political views from what we think is happening. And our political identities are paramount now. So why should Wall Street practitioners, when we enter this cube of our trading desk or the CEO suite, all of a sudden shed that which makes us human? All of a sudden shed the fact that our social media networks are giving us algorithms that are reinforcing everything we think. We read press that is bias all day long, and it's usually bias in a way to reinforce our views. So I think it would be highly hubristic for us as a community to think that, oh, we can avoid it here. Of course we can't. And therefore, if we're rooting for a certain political outcome, you have to be aware of that. And the argument that I'm making is we have a risk that Wall Street's objectivity will come under threat if they don't have the honesty push of mark to market. Those days when you get punched in the stomach by a change, to your point, it may be wrong. You may claw it all back. But boy, do you reassess everything you've ever thought about yourself and about your investments when your stuff is down.
What is it that keeps you up at night? What is the next big risk in your view?
I think the next big risk facing Wall Street is how do we remain objective in a sea of subjectivity? And when our incentives, the more and more assets are subjectively marked, are pushing us in that same direction. Does Wall Street risk it losing this island of objectivity that today, frankly, in this environment, is more special than ever? If our job is to be smart and fast in making investments, it's getting harder to do that because you have to spend a decent amount of time figuring out, hey, is this true? Is this really, is this a real video? Does this person know what they're talking about? And there's a cost to that.
Coming up, 6th Street's Josh Easterly. This is Bloomberg. Welcome back to The Next Big Risk. I'm Sonali Basak. As co-CIO at Sixth Street Partners, Josh Easterly knows how to manage risks. But he fears that the next generation and those that move from investment banking to private credit might not understand the precariousness of private credit.
On private credit, to me, the thing that worries me the most is that an asset class has grown, and there's a good reason why it's grown, that we don't deliver on the promise because we haven't developed talent, and talent hasn't caught up with the asset class.
This is an asset class that at the end of last year was north of $1.7 trillion. Yeah. It's an asset class that many investors believe is the future of finance in many ways. What is the promise? I
think the promise is durability of returns and a narrow bound of returns. But as the asset class has grown, it requires additional talent to actually provide those returns to investors. If you take a step back, why people like the asset class? People like the asset class because it's a better model than traditional banking. It has match funding, there's not an asset liability mismatch, and the returns are durable. The challenge is that it takes an investor mindset to actually be able to deliver those returns. And people typically think about the business model having either one of two constraints, which is one constraint is capital, and the other constraint is opportunities. That's actually not the constraint. Capital is not the constraint, and opportunities is not the constraint. The real constraint is actually people to deliver the returns.
Is another way of saying this, too, is that because returns were durable in the past, it doesn't mean that they necessarily will be durable in the future, depending on who's running the money.
In the old model, where it was a banking model, that model was a model where it was a distribution model. It was in the moving business. And so you had the difference between where assets were created, originated, and ultimately sold to asset managers. In the private credit model, that model has collapsed, where it's not only an origination business, but it's actually more importantly a storage business. And so you have to have a skill set that's different than the traditional banking model, which was that skill set was actually very narrow. Now the skill set needs to be much broader and much more focused on risk management.
So what happens then if you have banking talent moving over to private credit? What might they not understand?
The best way to think about it is a banker thinks about a asset return in the expected return. What is the average outcome? An investor thinks about it as what's the distribution of outcomes. So we can actually think about the average being the same, but what really matters to investor experience and to the performance of that asset class is what's the actual distribution.
A smart investor once told me that when it comes to credit investors, the biggest secret is not to lose money. Do you think that what will happen is if you have this inexperienced group of investors coming into these really fast-growing industries, private credit and all of the types of private credit around it, that they may not know the risk they're underwriting?
Private credit's about loss avoidance. I think the easiest way to frame it is, in private equity, for example, the nature of private equity, you only have to be right about 70% of the time. If you make 3 times your money on 70% of your investments and lose all your capital on the other 30, it's a 2 times fund, and it's probably a top quartile fund. In public equities, you got to be right a little over 50% of the time, in long, short public equities. In venture, you got to be right about 20% of the time, because your winners pay for your losers. Because of the nature of credit, you got to be right about 99% of the time. That takes a really different mentality and takes a group and culture who really is focused on tension around decision making and tension around not losing money. And so that's what keeps me up at night.
Are you afraid now that there are already people who have let standards get too loose in the industry?
I'm afraid that the asset class has grown where there is capital flowing to the lowest common denominator, where the cultures and the talent is not prepared to deliver on the asset class returns. I want the asset class to do well, because that will do well for everybody. And so I want to make sure that there's durability of returns and we deliver on those promises for our allocators and investors.
Do you think a lot of people who come into private credit for the first time Do you think that they maybe misunderstand a few things about the industry, given that it is private and they don't see the marks every day? Do they think that that means that things don't move around much in price, that they are inherently safer?
Don't get me down the marking rabbit hole. I actually think just because an asset class doesn't trade doesn't mean the value of that asset class doesn't actually move. And so with private credit, the biggest challenge is your ability to create liquidity when you make a mistake is more narrow because you're the owner of the asset, of that asset, and likely maybe the sole owner of the asset or one of a few people of the owner of the asset. So there's not a lot of people following that asset that can provide you liquidity. So you own all your mistakes. I think that is the biggest challenge with bankers where the perception is if I make a mistake, I'll be able to sell it and there will be another buyer of it. In private credit land, that is not true. Ultimately, when you generate that return, it's going to be whatever your return is, less losses.
Doesn't mean you have to kind of stress test your employees against scenarios.
You have to make sure they understand the weight and make sure they have tension around every decision they make. Understand that ultimately the decisions they make have a direct impact on teachers, on firemen, on police officers, on savers. Those are ultimately our clients, and it's heavy.
That's it for this episode of The Next Big Risk. You could watch previous interviews on Bloomberg.com and on the Bloomberg terminal. I'm Sonali Basak, and this is Bloomberg.